Welcome to this explainer. Today, we're diving into the fascinating and honestly entirely paradoxical Q2 2026 earnings report from Baidu. Now, if you follow the Chinese tech sector, you already know Baidu has been working relentlessly to pivot its massive enterprise away from its traditional roots and squarely into the future of artificial intelligence. But, numbers don't lie. And when you peel back the layers of this data, it paints a picture of a company caught right in the middle of a massive, incredibly expensive, and kind of painful transformation. So we're going to look closely at the data today to separate the flashy headlines from the actual economic reality.
Let's jump right in with a figure that is just absolutely massive, plus 283%. That is Baidu's GPU cloud revenue, and it has quite literally exploded, growing by 283% year over year. I mean, in the world of enterprise technology, triple-digit growth at this scale is just staggering. It proves that Baidu's underlying infrastructure is in incredibly high demand right now, as companies rush to secure the compute power they need for their own AI ambitions.
But hang on. Right next to that explosive growth sits a completely different story. Net income attributable to shareholders actually collapsed by roughly 68%, dropping all the way from 7.3 billion down to just about 2.3 billion RMB. So we've got total euphoria on the infrastructure side paired with a massive plunge in actual shareholder profit. Which brings us to Section 1, the AI growth paradox.
Seriously? How can a company that is growing its most cutting-edge division by triple digits simultaneously suffer a massive profit collapse? It seems completely counterintuitive, right? Well, to really understand this paradox, we have to look at Baidu not as one unified business right now, but really as a tale of two entirely distinct entities moving in completely opposite directions. On one side, you have the old Baidu. That's the traditional search and advertising engine that is currently shrinking. And on the other side, you have the new Baidu, the highly anticipated AI infrastructure business that's exploding in growth. The financial friction we're seeing is basically what happens when these two tectonic plates rub against each other.
So let's move to Section 2, the shrinking legacy engine.
Let's take a look at the traditional economic engine that built Baidu into a powerhouse in the first place. What's really fascinating here is that even though AI is undeniably the future, the legacy online marketing business still commands a much larger absolute slice of the revenue pie. Online marketing brought in 13.1 billion RMB in the second quarter. Now compare that to the booming AI cloud infrastructure, which sits at 7.3 billion RMB. The AI side is growing fast, absolutely, but the legacy ad business is still the heavy anchor carrying the bulk of the absolute revenue weight for the entire company.
However, that massive legacy slice, it's shrinking, and it's shrinking fast. Online marketing revenue dropped a severe 19% year over year. So what's causing this? Well, independent sources like Reuters point to broader macroeconomic pressures. We're talking about a notable downturn in the Chinese property sector combined with generally weak consumer spending, which basically means businesses everywhere are slashing their ad budgets. The economic environment simply isn't supporting the kind of marketing spend that Baidu relied on for years.
This leads us to Section 3, the exploding AI cloud.
As that old engine sputters, Baidu is furiously building a new one to replace it. And I gotta tell you, the pivot is incredibly real. Baidu's AI-powered core revenue hit 12.5 billion RMB. That's a 25% increase. The AI cloud overall is up 50%. And of course, that monstrous GPU cloud number is up 283%. According to Baidu, these AI-related segments now account for roughly half of their general business revenue for the second consecutive quarter. They are successfully changing the very DNA of their revenue streams.
But if we look a bit closer, there is a massive discrepancy hiding in this data. Baidu is highly successful at monetizing the back-end hardware, the infrastructure layer, which is obvious from that 283% GPU cloud growth. But look over at the consumer layer. Revenue from AI applications was only 2.5 billion RMB, growing at a measly 3%. This tells us that while companies will gladly pay top dollar to rent Baidu's servers and computing power, Baidu is really struggling to grow the consumer-facing AI applications at anywhere near the same pace. The boom is heavily lopsided toward the back end.
Let's head into Section 4, the hidden cost of AI.
So this brings us to the core complication of this whole explainer. Why isn't all this incredible infrastructure growth translating into a higher bottom line for shareholders? The reality is that this new AI engine is just incredibly capital intensive. AI infrastructure isn't just a simple software update, right? It's an intensely capital-heavy foundation of physical computing, massive data storage, high-speed networking, and those incredibly expensive GPUs you need to train and serve sophisticated models. It's kind of like trading in a fleet of bicycles for Formula One cars. Sure, they go a lot faster, but the fuel and maintenance costs are astronomical.
As Baidu pours money into acquiring these servers and hiring elite engineering talent, their cost of revenue actually ticked up 4%. Growth, as it turns out, is very expensive.
This creates a classic tech dilemma. You're spending heavily today to build the infrastructure of tomorrow, while your current profit margins take an absolute beating. Investors want returns now, for sure, but building the future takes time. And this is exactly why Baidu CEO Robin Li has been publicly preaching one specific word: patience. He's emphasizing that sustained technology and talent investment is just an absolute requirement for long-term competitiveness.
And adding some severe pressure to these massive costs is the fierce Chinese AI battlefield. Let's talk about the ERNIE problem. Baidu's flagship AI model, ERNIE, doesn't exist in a vacuum. Reuters noted that ERNIE had actually gone months without a major upgrade, all while highly aggressive competitors continued releasing newer, shinier models. So Baidu literally can't afford to take its foot off the gas pedal. They have to keep spending vast amounts of capital just to stay relevant in a super crowded space.
All right, Section 5, Bull versus Bear Scenarios.
So, with a shrinking legacy business footing the bill for this expensive AI pivot, we are basically left with two potential futures. The bull case is highly optimistic and relies heavily on scale. It argues that Baidu can leverage its absolutely massive existing footprint. Specifically, those 644 million monthly active users on the Baidu app reported back in June. The bulls believe Baidu can eventually push consumer applications to this massive audience, transition their enterprise clients to durable, recurring, high-margin AI contracts, and successfully replace those dying ad economics with a much more powerful technological foundation.
Conversely, the bear case issues a pretty stark warning. The bears will argue that rapid infrastructure revenue growth simply doesn't guarantee actual profit. The real fear here is a timing mismatch. What if the legacy advertising business bleeds out and shrinks much faster than the expensive AI investments can truly pay off? If intense competition forces Baidu to keep capital expenditures high and prices low, those margins are going to remain continually crushed, creating a long, painful transition.
Which leads us to our final section, the verdict. Watch this number.
If we really want to know which of these two scenarios is actually playing out, we need to look past the flashy growth percentages and zero in on one specific area: operating cash flow. In Q2, Baidu's operating cash flow sat at a positive 3.4 billion RMB. Now this is vital because it proves Baidu isn't just burning cash blindly in a panic. They are actually maintaining a very delicate balancing act, generating enough cash from operations to keep the lights on and fund the pivot for now. In fact, this marks their fourth consecutive quarter of positive operating cash flow. Ultimately, as you digest everything we've covered in this explainer today, the definitive takeaway for Baidu, or honestly, any legacy internet company pivoting hard to artificial intelligence, isn't about who has the flashiest revenue growth percentage. It really all comes down to this single, unyielding question: how much profit does that growth actually produce? When Wall Street looks past the AI hype, this is the metric that will decide Baidu's ultimate survival. Which brings us to the ultimate question for the entire tech industry right now. Are companies like Baidu building the technological wonders of tomorrow, or are they just building the most expensive digital graveyard in history? Keep questioning the data, and thanks so much for exploring it with me today.